What are the steps to establishing a tax-free Smith fund for your financial goals? In this educational episode, I'm going to address how do you open up a Smith fund. So what is a Smith fund? Smith is an acronym that means saving money in tax-free homes. Smith fund is also a max-funded index universal life insurance policy that is structured correctly and funded properly. And of course, the main question I get is how do you open one of these things? Like, how do you open up a Smith fund? So my name is Justin Smith, and I've been helping people optimize assets while also mitigating the risk of taxes since the turn of the decade. So if you didn't know before, my favorite financial vehicle or tool allows you to access your money tax-free and also accumulate your money tax-free. This is not for just at retirement. This is long before retirement. This could be used for business purposes, college funding, or whatever you choose. Like I said before, this could be used for any goal. Really, any goal that's 5 years or longer down the road, this could be used for. Did I forget to mention it's tax-free? Then of course, every year in your golden years, you're earning money or you're accumulating money tax-free. So every million you have in your portfolio of Smith funds, you can gain anywhere between $80,000 to $100,000 each year, tax-free. Those numbers will be considered 8 to 10% payouts of income for the rest of your life. This is usually without even depleting your principal, totally income tax-free until you die. Then anything else that's left in there blossoms and then transfers to your heirs tax-free. By blossom, I mean increase in value. This means depending if you're actually getting closer to that time, when you die, every million in your portfolio of Smith funds, your max funded IUL policies, will blossom to $2 million. There is literally nothing else in the Internal Revenue Code that does this. This is crazy because this is where the banks and the credit unions also put their money. What's actually cool about this is if a bank or credit union loses money or goes out of business, you're still safe with your money in these vehicles. So my goal is to put my serious cash in these vehicles where you can pass the leverage test, the protection test, and the growth test. And of course, I want to earn a rate that is equal to or even greater than what inflation is doing at that time. So far over the last 40 years, Index Universal Life has outpaced the inflation in the 80s and the inflation we had just a year or two ago, which was 15%. Now, if this is something you want to learn more about, I suggest you hit that subscribe button. But not only hit that subscribe button, stay to the end of this video because I have a gift for you. I have a free ebook called the Smith Fund ebook where it teaches you A to Z of how to grow your money and be your own bank tax-free. So in this series, I will be talking about the responsibilities of the max funded tax advantage life insurance concept, the Smith Fund, and why it's only a Smith Fund if it's funded properly and structured correctly. This also means that you're grandfathered in under the Internal Revenue Code's 3 sections. This means your money grows tax-free, your money can be accessed tax-free, and when you die, the money blossoms and transfers tax-free. So now we go back to the question of how do we open one of these things? Like, how do we set it up? The Smith Fund is not like walking into a bank account or credit union and opening up a bank account. So the real question should be, how do I establish one? How do I create one? And how do I even qualify for a Smith fund? This instrument also requires that there is life insurance on the individual. The individual also has to qualify for life insurance in order to be able to grow your money tax-free, access your money tax-free, and when you die, the money would transfer and blossom tax-free. Now, most people who come to me, they want to have leverage, protection, and they also want to have growth in their financial vehicles. And of course, the rate of returns for it to be tax-free. But when you think of the term life insurance, most people would say, oh, I already got it through my employer, which is never enough. But the cool thing about it is they don't have to worry about physically paying for life insurance. Now, that's kind of how the Smith Fund or your max funded tax advantage life insurance contract works. But also keep in mind that nothing's free. The insurance is basically coming along for a ride that is paid for from a small portion of your investment or whatever you decide to fund into this policy instead of going towards taxes. I'd rather pay for the insurance at a small number than paying for taxes on the money that I'm putting in and being able to pull out tax-free of this policy. If you were to put your money in traditional accounts like the IRA or the 401ks, you may earn 15%, but you're only going to net 10 or 9% after paying the taxes. But in the Smith Fund, your IUL policy, I only have to net 10%, or I only have to earn 11% to earn a net 10. Now, that 1% is not going to taxes. That 1% is the cost of insurance that the IRS requires us to have for it to be tax-free. So if I earn 7, I get 6. If I earn 10, I get 9. If I earn 25, I get 24%. And this is over the life of the contract. So I wouldn't really say it's a cost. I would mostly call it a benefit, if you know what I'm talking about. So yes, insurance is involved. But let's break this down a little bit. There are basically 5 categories when you set up an insurance account. An IUL or a Smith Fund is an insurance contract with an insurance company. The insurance company is the insurer. Now, if an insurance company is going to set up a life insurance policy, even if you're going to design the life insurance policy the way I'm talking about, this is where you're getting the less amount of insurance that the IRS will allow you to get away with while putting or funding the most amount of money into your policy that the IRS will let you put in. So it then turns into a cash cow, but you still need to qualify for the amount of insurance. For example, let's say I want to reposition over the next 5 years, $500,000. Now keep in mind, I can set up a Smith Fund or an IUL policy to accommodate $500 a month, $50,000, $500,000, or even $5 million. But let's just use $500,000. The IRS will say, if you want this to be a tax-free cash cow, you're required to put in 20% each year, meaning you're going to have to put in $100,000 each year for 5 years. And of course, after 5 years, you have fully funded that policy. You can't put any more in. Now, if you did put more money in, the insurance company would have to refund you that money. Now, there's no limit of what the $500,000 can grow to. With an average historical rate of 7.2% annually, that $500,000 will grow double every 10 years. And then it will double to 2 million in another 10 years. And then 10 years after that, it'll double to 4 million. This means in 30 years, your $500,000 can grow up to $8 million. We do plenty of illustrations about this. So when you're structuring a Smith Fund or a portfolio of Smith Funds to do that, with $500,000, you can buy a lot of insurance. But that's not the goal here. You want the least amount of insurance possible. Now, the older you are, the more it might cost, of course. If you're 60 years old and you want to put $500,000 in and you want that money to grow tax-free, you may have to get $1 million life insurance policy. But as you put that $500,000 into the policy, it qualifies as a part of your death benefit. So the insurance company is only at risk of half of that. So that means you only have to qualify for $500,000. They also only charge you on the $500,000, meaning you won't have to qualify and you won't have to pay for $1 million worth of life insurance. So at that point, you're self-insuring. This is something you can learn about all over this YouTube channel, and you can also check it out in our free ebook, A to Z of how to grow and properly structure your tax advantage, max funded, index universal life contract, what I like to call the Smith Fund. So the cool thing about this concept is the cost of insurance, the older you get, even goes down. But when it comes to qualifying, opening $1 million policy, you have to have an insurable cause of why you need $1 million policy. The underwriter knows that you don't have to put $500,000 into $1 million policy to pay for it. Honestly, you can put in $10,000, die the next day, and you'll have $1 million waiting for your heirs. So like I said before, when you put that $500,000 in, the insurance company is only on the hook for the other $500,000 on that $1 million policy. So they have to make sure that you actually qualify for that $1 million policy. But what does that require? The insured who has the insurance on them has to make sure that there's an insurable interest between them and the beneficiary when it comes to opening and qualifying for this policy. Let's say I want to open up a policy and I want to name my wife the beneficiary. I have to prove that if I die, my wife would suffer economically. Or maybe it can be my children, or even I can put it in a trust. So you have to prove when you open up that there's an insurable interest to justify that $1 million. This is usually a lot more easier to prove when you have a spouse or this is for your children as a death beneficiary. I'm hoping this makes sense. Now, when it comes to the owner of the policy, it's usually the insured, but it doesn't have to be. Sometimes the owner of the policy might not be able to qualify. Maybe they had a heart attack last year. By the way, you'd actually be amazed how many people still qualify even after having a heart attack. So don't doubt yourself. So if you are able to get insurance and you're rated, you can lower the cost. So when you're 60, or if you're 60 and 70 it won't cost any more than a 20-year-old female cross-country runner, fully healthy. This is something else you can learn about on this very old channel. Like I said before, if you stay to the end, I got an ebook for you that talks more about this subject. But if the owner can't qualify for the policy, the owner can still own the policy on its spouse or children. So as the owner of the policy, they get all the tax-free growth and the tax-free access. So you really don't have to be insured to be the owner. There are plenty of people that own them on their spouse and their children. So now you have the owner and the insured who are normally the same people, but they don't have to be. Then you have the premium payer. This is the one who's putting the money in. This could be a situation where the grandma and grandpa are paying for the mom and dad's policy while the beneficiaries are the kids. So we have the insured, the owner, the payer, and the beneficiary. So they all can be different people. Does that make sense? So how do we open up one of these bad boys? You go to a licensed professional like myself. You have to go to someone who's licensed. If you were to go to an insurance company and ask for one of these, they'll end up sending you to a licensed professional anyway. I'd also be a little worried if they send you someone, because that person or that professional might be a professional, but they still don't know how to properly structure or correctly fund these policies. I'm learning that just because you're a financial professional or a licensed insurance agent, you still may not know how to fund these things or properly structure them. So for these, you have to qualify financially by guidelines, and you also have to qualify health-wise. Once you get that taken care of by a specialist who knows how to do this, you can minimum fund it like $5,000 or $10,000, or you can put in $100,000. These things are very, very flexible. If you put in any more than that $100,000 a year, it would create a MEC, which is a modified endowment contract. This means when you want to take that money out, it won't be tax-free anymore. So you want to go to a professional who knows and understands these parameters so you don't get hit with these taxable events. Most of the time, it's really simple to open one of these, but sometimes, they have to get the records from your doctor. This means it can take weeks to a month to actually get you qualified for these products because the underwriter has to go and send that information and receive that information from your medical provider. So we fill out the app, get you approved, make sure it's funded according to the IRS guidelines with tax-free access, tax-free growth, and when you die, it'll blossom and transfer tax-free. But hey, if this is something you're thinking, Justin, I've got to get my hands on this. How can I learn more about this? My team and I have created a free ebook for you that talks about steps A to Z of how to properly structure and properly fund your Smith Fund, your maximum tax advantage life insurance, index universal life insurance contract, so you can have a great future for yourself and your family. My name is Justin Smith. This is the Investments channel, and we'll see you next episode. Peace.